Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. And we're going to cover key opportunities and risks for investors tied to developments around the world. And best part, we take your live questions from the chat on YouTube, so you can ask us what's on your mind at any time by entering it in the chat. And we'll get to those questions in just a few minutes after we share some of our latest insights. Now, as always, we've got a few required disclosures before we get started. We don't know you personally, so we don't make personalized recommendations, but we talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly, and why. Of course, things can and do change, so all the thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind on our show today. Now, as always, I'm joined by Michelle Ghibley and Heather O'Leary on the Global Strategy team here at Charles Schwab. Good morning, ladies.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As always, I'll be watching the chat and send your questions in. We will get to those in just a little bit. Jeff, can you go ahead and kick us off with a quick rundown of what we're watching this week that could move the markets?
Sure, Heather. So right now, I think Trump and Putin are having their call, so we'll see what comes out of that. Also today, we've got the UK-EU summit in London. That's expected to focus on defense issues and post-Brexit cooperation after the UK struck a trade framework with the US. One of the goals of Brexit, now the UK pivoting back to seeing how close they can get to the EU on a number of key issues that really Brexit marked a break on. So we'll have to see how that progresses. That'd be interesting for those two major economies. Now, the gathering group of 7 finance ministers and central bank governors takes place Tuesday through Thursday of this week in Canada. Of course, it's Canada, one of the G7 countries. President Trump's tariff policy is going to mean tensions are probably high with all those folks together, talking about what it means for their purview from being finance ministers. So you got the heads of Treasury and central bank governors there. Of course, Trump has wanted to make Canada the 51st state, and that has angered the G7 host Canada. We'll see where that comes up at all. We also want to watch currencies closely this week. They're increasingly showing up in trade conversations. We've seen Taiwan's dollar surge. South Korea and the U.S. have discussed foreign exchange, and Japan also wants to talk currencies. Of course, Japan, a G7 member. The next semi-annual U.S. Treasury currency manipulator report, it's hard to say, is due any day. So that's where the Treasury comes out and says if they believe other countries are manipulating the currency and then what they should do about it. That'll be interesting to see, particularly with its take on China. So that'll be going on. On Thursday, we're going to get the preliminary May purchasing managers indexes. You know I love those reports for the Eurozone, for Germany, France, the UK, Japan, the US, and India. They're going to give us the latest read on business sentiment here in May. So we don't often get May data in May, right? You usually get economic data with a month or two lag. We're literally getting it during the month that it's happening. It's a survey, but it's usually a very good one. We'll have to see. It's usually a pretty good indicator of where earnings are headed over the next quarter. And of course, this comes after tariff negotiations have started to bear some fruit. So we'll see how that impacts sentiment. Economists are expecting a little bit of an improvement from the April reading. So we'll see what that means for business economic sentiment and also earnings sentiment. Now, this week, earnings reports are expected from companies including Analog Devices, Autodesk, Baidu, and Home Depot. So quite a wide variety of companies to give us a little bit of a perspective on what's happening. In Europe, it's been the best earnings season in years, with 60% of the companies in the Europe Stock 600 index exceeding analyst estimates. That's 6 percentage points more than average. That's not something you're seeing in the US, where things are slumping a little bit. It's also one of the reasons why we continue to see rising earnings estimates in Europe, at least on a dollar basis. So that's an interesting thing to keep a close eye on this week. Now, Michelle, last week we covered the news that broke that about this sort of de-escalation in the trade war between the U.S. and China. Now that we've had some time to think about it a little bit more, what are the additional takeaways here on the U.S.-China relationship?
Yeah, I mean, the de-escalation between the U.S. and China is certainly a positive, but tariff troubles remain. The worst case scenarios certainly significantly reduced, but the 90-day delays, and we have a couple of them, they just prolong the uncertainty over what trade agreements may look like. And the end game for tariffs is still unknown. If we look at the U.S. tariff rate, it's still the highest since the 1930s. We don't know how businesses and consumers are going to respond, and there's still many trade-related items left to negotiate. Last week alone, Walmart said it had already raised prices on some goods and expects increases to become more significant as the year progresses. And President Trump pressured Apple not to shift production to India, and also pressuring Walmart to eat the tariffs over the weekend. In fact, I would say there's still more ahead of us on trade negotiations than have been completed. And the thing that's important to note is that tariff rates could still rise from here. That's the lesson from the first Trump trade war with China. And we had a 90-day reprieve in late 2018, early 2019. And after that 90-day pause, if you will, tariff rates increased again. This time, after the de-escalation with China, U.S. Treasury Secretary Bessent, he said that the 34% reciprocal tariff was the ceiling. And when you add that to the 20% fentanyl-related tariff, that suggests a 54% rate on Chinese goods is still possible, although they also said that some amount of the fentanyl tariff could come off. In the wake of the UK deal, President Trump this time said that 10% was probably the lowest rate and not necessarily a template for other countries, suggesting that rates could be higher. And again, over the weekend, Trump said there wasn't time to do deals with all the countries wanting to do deals. And Bessent said those not negotiating in good faith will receive letters in the next 2 to 3 weeks that will assign tariffs, or, as Trump has said, the rates that they will pay to do business with the U.S. What do you think, Jeff?
Yeah, so we've had this sort of 30% additional tariff on China this year for this 90-day period, right? So that's so we're looking at 38 or 39%. But as you know, it could go back up into the 50, getting close to that 60% rate that Trump campaigned on. So it is a worry. And as you point out, the last time we had a 90-day pause, both sides committing to work through their differences, it didn't work out well. So we've got a lot of bad blood there and some bad history on this as well. Now, maybe there's more incentives this time for them to come together and come up with something, but it's certainly a tough slog here over this 90 days for U.S. and China to avert a reimposition of even higher tariffs there. But I'd also point out, on top of all of this, Michelle, we've got the sector tariffs still due. So we've talked a lot about country-level tariffs, but we've got these sector-level tariffs on semiconductors and the related whole tech hardware supply chain, along with tariffs on pharmaceuticals. They're now out of their comment periods. Those periods ended May 7th, where companies can say, hey, please don't do this, and here are the reasons why. And therefore, those new tariffs could be announced at any time. They have up to 270 days from when those investigations begin to then implement them, but that could happen at any time. So sometime this month or next month, I'd expect to see those semiconductor and pharmaceutical tariffs put in place. And when you add those to steel and aluminum and auto sector tariffs already in place, these may be the more important ones impacting businesses going forward, rather than the country level tariffs, at least for some countries. You talk a little bit about like Korea, right? So we know South Korea and the US are in trade negotiations right now, but those country level negotiations might mean little if sector tariffs are substantially higher. So of Korea's 128 billion in exports to the US last year, over half were intermediate goods that include semiconductors and auto parts and steel. So the uncertainty around tariffs, particularly sector tariffs, could kind of overwhelm any kind of breakthroughs on the country front and lead to a return of maybe higher tariff levels, and that could lead to some ups and downs in the market. So I am concerned about this, and there's a whole nother way. I think the market has kind of gotten in its head that we're past the peak tariff risk. But given that we haven't even heard about two of the major tariffs on semiconductors and tech hardware and pharmaceuticals, there may still be quite a bit to come, Michelle.
Yeah, and as we already said, there's still many countries left to make deals with, or in particular, I would look at the EU, the European Union and the US. That's a really big trade relationship. Pharmaceuticals is important there, as well as autos. Now, Vice President Vance met with European Commission von der Leyen yesterday, but negotiations may not be easy. Just on May 8th, the EU laid out retaliatory measures on 95 billion euros of goods if a deal fails, and they may not accept 10% as the floor for tariffs. Also remaining is the outcome of the U.S. investigation of digital service taxes posed by non-U.S. countries, and the initial USMCA deal is up for review in July of next year, but that could be pulled forward. So, these tariff troubles could continue to kind of recycle through the news and hit stocks. Despite this, it's important to note that other countries are looking to accelerate trade with each other and strengthen their own economies. So already this year, the UK and India made a free trade deal. China signed dozens of cooperation agreements with with Vietnam and Malaysia in April. And then there's been talk about easing trade barriers between the EU and China on electric vehicles. And then last week, both French President Macron and new German Chancellor Merz both talked about deepening cooperation with the UK, and areas that they mentioned for increased cooperation were defense and security, as well as trade. Also last week, Merz backed President Trump's goal for NATO to spend 5% of GDP on defense. That's up from just 2% now. Germany, their fiscal deficit has been constitutionally limited, and they have a lot more room to spend as a result. Their debt to GDP was just 64% last year. It's nearly half of what we have here in the US. And so Germany, they've announced basically 1 trillion euro stimulus for defense and infrastructure, and it could really transform what is Europe's largest economy. It may not be a smooth ride there. It may take time for spending to ramp up due to a long, drawn-out process for procurement, permitting, and planning, as well as labor shortages. So there may be patience needed. That said, the combination of defense and infrastructure spending could add 1.5 percentage points to economic growth every year for the next 10 years. And this could really help Germany break out of stagnation and provide a new growth story in Europe.
Yeah, I mean, we've been talking about this all year, right? I mean, this is one of our stories going into this year. We've talked about the European MAG 7 defense stocks, the 7 big defense stocks in Europe, stocks like Rheinmetall in Germany or Thales in France, just as 2 examples of big defense stocks in Europe. These have been part of this MSCI EMU, European Monetary Union, Aerospace and Defense Index that we've been pointing to all year as a real beneficiary or potential beneficiary of this massive increase in defense spending. I just pulled up the chart here. So that index is up 48%. We started talking about it back in January, when it sort of just come out of the gate. So really incredible performance. Compare that, the 7 stocks in that index to the MAG 7 stocks, which are still down 5% this year, despite the tech rally that we've seen, take place here lately. Still down 5% versus up 48% for those European defense stocks. So it's just been a favorite of ours. We continue to favor European stocks overall, not just the defense space. Rising earnings and economic growth this year. As a matter of fact, excuse me, I just posted it on my X feed. We just got the latest leading economic indicator from the OECD. Liz Anna just posted, just showing, the U.S. was declining, one of the worst declines we saw the leading indicator for the U.S. fall in April. In Europe, it went up. It went up for the 30th month in a row. This is the first time we've ever seen, since 1960, when the data begins, 1961, the data begins. We've never seen 30 straight months in a row of rising economic momentum in Europe. So really quite a bit to talk about with regard to that. So rising economic momentum, earnings growth following that, talked about that earlier in the call, the best earnings season for Europe we've seen in years. We've got a combination of fiscal and monetary stimulus, right? So Michelle, you just talked about all the fiscal stimulus, infrastructure spending, defense spending. So the government spending more money. At the same time, we've got monetary stimulus, rate cuts from the European Central Bank. The 2 of those have not happened at the same time in more than 15 years, since the last time European stocks were leading the markets in the 2000s. We've got some regulatory reforms coming into place as right-leaning governments that were elected last year begin to impact policy. We had Merz in Germany just talking about, yes, okay, we're going to embrace nuclear, along with France. Right, so pushing the Greens to the side, saying, look, we need an energy independent future, and nuclear is part of that. So we're seeing some policy initiatives there. that are economically positive, at least in the near term. And of course, you still got attractive valuations. I keep pounding the table on that. Valuations in Europe are still in line with their 10-year average, not extended like they are here in the US. So you add that to relative political stability in Europe and a rising euro, and you get a very bright outlook there. So we've been long, favoring European stocks here. They've been outperforming the US stock market by 35 percentage points since this bull market began in October of 2022. We've talked about it relentlessly on the show. I still think a lot of people are missing that really strong bull market story. But I'm going to encourage that longer term view. It's not just this year. It's not just the defense stocks. It's a bigger picture view. Market watchers tend to define market cycles by bull markets, right? Those periods between 20% declines that we call bear markets, right? So bull markets are the periods between bears. And the current bull market, as I mentioned, began back in the mid-October of 2022. And since then, international stocks have been outperforming US stocks, which is the opposite of what had been taking place in that cycle that led up, that followed the great financial crisis that led up to October of 2022's bear market. The outperformance has been huge. Like I said, European stocks have, which make up more than half of the international stock market, have outperformed by more than 35 percentage points relative to the S&P 500. So it's really a positive story, and it's international stocks overall. If you look at the EFI index of all the international developed markets since the bull market began, it's been outperforming the US. I have been using a shark chart for a long time to illustrate this, and I want to bring it back here because it's probably one of the things I'm most known for. I think I started in 2007 or 2008 using these shark charts to talk about cycles in investing and the danger posed when the trend changes and the jaws begin to bite down. And here we are, the jaws are biting down. Historically, at the start of each cycle, the lines have changed direction. The leader becomes the laggard. So the leaders of the last cycle reverse and become the laggards in the next one. When the orange line is rising, U.S. stocks are outperforming, as they did in the 1990s and the 2010s. And when the blue line's rising, international stocks are outperforming, as they did in the 80s and the 2000s. They're just inverses of each other. One is the U.S. divided by international market. The other is the international market divided by the U.S. Again, it reverses every cycle, but the degree of outperformance differs. Now, the reasons those jaws are closing now are behavioral as much as they're fundamental. After a full cycle of outperformance, trends naturally begin to revert, and I think that's where we are now. So again, it's not just about this year. It's not even just about the last year or two. It's really about a longer-term cycle of international outperformance beginning to take shape. So, Michelle, after U.S. stocks outperformed for many years, many investors maybe overweight the US and underweight international stocks, but this might be true in Europe as well. Is that right?
Yeah, so typically investors have a home bias. They have a preference to invest in the geography they know the best, where they live. So it's surprising to see how much Eurozone investors poured into US assets, particularly stocks, in recent years. In the fourth quarter of last year, Eurozone investors bought more US assets than domestic assets. In fact, they invested 76 billion euros more in the US than they did in the Eurozone. And then when you add in market gains, their holdings in the US have really increased. Now that US stocks have been underperforming this year, global investors are reassessing their allocations given the unpredictable and uncertain policy moves in the US, as well as the potential for a new growth story in Europe. It's possible Eurozone investors will decide to repatriate money back to the continent. Now, if they reduce their US weight from what is currently 14.4% to 11.3%, I think we have a chart on that. GaveCal estimates this could result in 1.1 to 1.5 trillion euros out of US equities and 0.5 billion euros from US bonds. Now, it may be unlikely that all its money moves very suddenly, and it's not certain where it will go, but it's not hard to think that some of this shifts back home to Europe, although perhaps some also goes to other geographies such as Japan or emerging markets. Reallocation by European investors could also be mirrored by other global investors, both in the US and Japan and elsewhere.
Yeah, it's interesting, right? So investors tend to chase performance. What's less often discussed, that's sort of widely accepted, but what's less discussed is what performance they seem to chase. And it's sort of interesting that if you look back historically, it's sort of that 3-year moving average of relative performance in markets. And we're getting to the point, October of 2022 is almost 3 years away, where we see that 3-year number really shift in favor of Europe and Japan and other markets as opposed to the US. And you can see that money follow, not only money coming out of the US by US investors investing overseas more, but international investors who have been chasing performance in the US reallocate back to their home markets. So a very good point, Michelle, and something that's probably overlooked. You're talking about billions here. It's a lot of money and is already seemingly beginning to shift. I already mentioned it's been a great earnings season. 60% of companies beating earnings estimates in Europe. We're only about 2/3 of the way through the season. The season's a little bit slower to get started over in Europe than it is here in the US. But it's interesting to note that what we've seen is that this better than expected performance has resulted in fewer European companies experiencing lower earnings guidance, sort of guiding the market lower on earnings going forward relative to the US, as you can see in this chart here. So this is a chart I've been putting together for the last, I don't know, a few weeks or months or so, just to sort of show this impact of what tariffs have done to earnings estimates, really just in the US, right? So if you take a look at this chart, this is on the left-hand scale here, which is the blue line that we're looking at here for the moment, is the S&P 500. It's a number of companies in the S&P 500, of which there are about 500. You'll see the number of companies getting downward guidance on earnings. This spikes up during periods of crisis, like the global financial crisis, like the pandemic, but also like during just the uncertainty associated with the tariffs. We did not see a similar spike, though, in Europe. We did during the great financial crisis. We did during the pandemic. We have not this time. The line has gone up a little bit in terms of the number of companies seeing downward earnings estimates, but really within kind of a normal band, not something that really is very alarming relative to the US. Both these numbers have come down as we move past the peak of the earnings season. That's good to see, but it's interesting to note that we continue to see rising earnings estimates for Europe, at least measured in dollars, this year, and that's encouraging, again, sustaining this European outperformance, giving investors more of a reason to maybe repatriate some of that money. All right, Heather, we covered mainly Europe here, kind of focused on that today, but let's move over to the chat Q&A and see what's on everyone's minds.
Of course, Jeff. The first, I would like to remind our viewers today that we do have a survey link that is available in the chat. So please go ahead and click on that and give us your feedback for today's session. We'd really appreciate it. Really, the first question comes up again, and it is about Europe. People want to know, besides companies affected minimally by tariffs and the defense industry, which you discussed previously, what else can we look at to see leadership within the EU going forward?
Financials have been the best performing sector internationally and within Europe. The big banks, the idea that there's going to be more economic support, but both with lower interest rates and rate cuts by the central banks, but also faster economic growth, lifting the long end of the yield curve. Banks in Europe, they lend a lot of money. Banks in the US are involved in a lot of transactional revenue, but in Europe, there's still a lot of lenders. And so there's capital markets and stuff too, but just if you think about lending spreads, right? So banks tend to lend out money on like the typical loan durations, like 5 years. So they tend to look at like 5-year rates versus the cost of their funds, what they pay on deposits is very short term, right? It's like overnight rates. It's like the European Central Bank policy rate. So as the European Central Bank keeps lowering short-term interest rates, the cost of what they're paying in interest on their deposits is going down. At the same time, this better economic momentum has sort of supported longer-term interest rates. So the spread that they're making on those loans, higher rates on the loans, lower cost on deposits, is really widening their profit margins. That's a real plus. At the same time, you've got pretty good credit quality across Europe. You're not seeing the same stress in the US where smaller businesses are being squeezed by higher import costs. That isn't the case in Europe. They're actually seeing some support now. The labor market, the pace of wage gain seems to be easing. Businesses seem to be more credit worthy. So that's a plus in terms of the loans that they've made not deteriorating. And then you've got, markets rising. So you've got capital markets activity picking up in Europe as well. So all the different drivers, I don't want to say all, but the vast majority of the drivers that benefit financials are really kicking in. I'd also note that banks don't have any goods exports, right? They're not selling anything that crosses a border that they'd have to pay a tariff on. So they're immune to the tariffs for the most part. Obviously, their customers are not, but they are. And then they're seeing a benefit from the fiscal monetary policy. So it's kind of like everything going right seems to be benefiting them. Now, things can change, but financials continue to be the best performing. And I'll just quickly, I don't know if Michelle, if you have anything to add, but I'm just going to quickly pull up, what the financials have been doing year to date here in Europe.
They're definitely among the highest performance and the biggest weight.
30% gain so far year to date. So that's relative to overall Europe, and that's in local currency. So in dollars. Let me just do that real quick. I know I just cut you off, Michelle, but I'm so excited. You're looking at 40% gain, 39.79% gain for European financials. Really strong numbers.
Yeah, I was just saying that financials are the biggest weight, both in the MSCI EMU index, the European Monetary Union, and in EFA. It's about 24% of each. So definitely a big factor. And as you mentioned, benefiting from the yield curve steepening.
Great point. Yep. All right, Heather, what else is out there?
Well, the other pertinent question of the day is regarding the Moody's downgrade on U.S. Treasuries on Friday. What take do we have from an international perspective on that?
Well, it's sort of inevitable. I mean, we've already had S&P and Fitch downgrade. One was, I think, due to the great financial crisis or the global financial crisis. One came after the pandemic. Now this one's coming after the tariff. So, obviously raises questions about the U.S.'s willingness to pay, and then, the potential to pay in a lower dollar, basically paying back this debt in a deflated currency, which is something that the U.S. is talking about with its trading partners, right? Basically revaluing the dollar lower against those trading partners, giving us an export advantage on our goods. They'd be cheaper in foreign markets because the price of the dollar would be lower. So that is also something that sort of weighs on the notion of the value of investing in U.S. Treasuries. So that's something that's out there. I mean, not seeing a huge, there's been a sort of a sharp move in the Treasury market. Today it was up and then it was down. I mean, yields are, let me just look, 4.48% on the 10-year. So really not reacting dramatically to this. There's not really any new news in the Moody's downgrade. That said, the euro is up almost 1% today on the news, right? Just a further reason for international investors to consider investing in stocks and bonds in their home currency, right? I mean, the euro is up 9% against the dollar this year. So, and the yen is up 9% against the dollar this year. So just another tailwind to investing in international markets is that potential currency depreciation of the dollar, which is not only the result of these widening budget deficits and pressure on U.S. fiscally, but also one of the intentional perhaps results of our trade policy. One of the ways in which tariffs may be offset is by weaker U.S. currency. It's something part of the negotiations taking place with a number of countries, particularly in Asia, but might be part of the European negotiations as well.
So looking at the other side of the globe, Michelle, maybe you have more insights. What do we have for thoughts on Asia, especially in the AI space?
Well, I would say that emerging markets are kind of an interesting play. A lot of emerging market has a big weight in tech. I think that, a lot of people think about emerging markets, commodities and materials, but that's really the past. The weight in tech and EM is pretty high, and a lot of those companies are increasingly making technology advances and benefiting from AI just as we are here in the US.
Anything else to add, Jeff?
No, I think that wraps it up well. I mean, I think that AI is an interesting longer-term theme. It's one that's going to become increasingly difficult to separate from just overall investing. In the way that we don't sort of think about internet investing now, the internet is part of everybody's business. AI is going to become increasingly part of everyone's business as well. And it's the users of that technology, I think longer term, that'll be the big beneficiaries of that. And there are plenty of those in the emerging market space as well. So interesting to see emerging markets now in their second back-to-back quarter of outperformance of the U.S. markets here, just as they did in Trump's first term in 2017. So we'll see how that continues to shape up. Obviously, a lot on the shoulders of China there and their continued investments in the AI chain. So let's wrap up the show. Thanks, Heather and Michelle, and our producers, Andrew and Gabe, and everyone for the questions and for joining us. The Memorial Day holiday means we're off next week, but we're going to return on June 2nd with our last show, episode 200. So be sure to tune in one last time as I share some wisdom gleaned from my 30 years in financial services and 25 as a chief investment strategist. See you again 2 weeks from now on June 2nd.